So hello, welcome, and today I want to talk about a very important topic which I see is causing a lot of confusion in many traders' daily trading lives. And I want to talk about wicks. Many traders have a very wrong understanding about what wicks are, how to use wicks, and how to interpret wicks on their charts. This is mainly because general trading education or any trading books they don't really talk about wicks in any other way other than that they are rejection formations. You will only see pin bars, and those long wicks then show you, the market is ready to jump in the opposite direction of the wick, but this is not true. It is not the whole story, and wicks can show or be many different things. And I just want to give you a few examples of what wicks can be as well, and how to use them or how to understand them in different contexts. So let's talk about a few scenarios. Here, for example, the market is at a range market. Here you can see that very clear. We put in a range top and a range bottom, and then you can see here is a very, very strong wick to the downside. Many traders will say, oh wow, this is a big rejection. The market is ready to jump and break out to the upside, continue its uptrend here. Not true. Or well, I should say this is not enough information, at least to make a trading decision. If you make a trading decision based on one wick alone, you have failed as a trader. This is what I would like always to call surface level technical analysis, where traders try to find ways or try to justify a trade based on very little information. The less information, the better. So they just look for one wick. They look for just one moving average crossover, they look for one signal on their stochastic, and so on and so forth. And those traders who want to make trading decisions based on just one little thing are using surface level technical analysis, which is not enough if you want to become a profitable trader over the long term. Trading is complex. It does not have to be complicated, but you have to understand that there is much more to trading and to reading charts than just looking at one wick or one moving average crossover or one stochastic or whatever, or one price action pattern, whatever it is, and then trying to make a living out of that. So instead of looking at this wick and saying, okay, this is a rejection to the downside, the market is ready to go higher, why not say that this wick can also show that there were so many sellers in the market that the sellers were able to push the price as low as this point. During all this range market, the sellers were never able to push price that low. So this can also signal in such a context that, okay, there are actually a lot of sellers in the market, but they don't have the complete majority yet. So there are still some buyers in the market, and the buyers were able to push price back into the range, but this can also foreshadow a reversal to the downside or a breakout to the downside, which eventually happened, and then we started this downtrend. So the first important point here is that look at a wick from the other point of view. Don't just see it as rejection, but also don't make a trading decision just based on one piece of information. Use more, and what I always tell our students, don't, if you see just one wick, then don't try to make a decision. Wait for at least a few more candles after that to see the whole picture. You can see there was a little bit of a momentum pause. The market just moved sideways, and then we followed into the direction of the wick. And then the market moved to the downside. When we look into the market or in the trend phase afterwards, you can see here, let me get rid of this. Let me get rid of this arrow. You can see here was then a candle, or the market sold off, and then here was a candle where many traders will panic because, oh no, the market is putting in a wick to the downside. It means rejection to the upside, and the market is ready to reverse. If I'm short here, then I need to cover my short, and if I'm not short, then I should get ready to buy. Again, no. That is not what this wick is telling you. First of all, it's important to understand a market will, or a trend will not just drop in one single line into your take profit. There are ups and downs, back and forth. Trend waves and correction waves will alternate in a trending market. So temporary pauses, even little corrections, are normal. Also, always try to understand where is a a pause happening in a trend. You can see that here's a very important resistance zone that turned into support here, and now the market is using that as resistance again on the way down. So a temporary pause makes sense here, and you can see afterwards the market covered the wick here. We came back one more time, and then we sold off again. And we see the same thing here. The market breaks out of the lows. You can see here a strong wick to the downside. Where is the wick forming? At a previous very important support level. So again, not a signal to, if you are short, to exit your short necessarily. It's not also a signal to get long, because the market is putting in here a rejection wick, if you believe this analysis. But it can also show you that, okay, the market dipped in one single very, very big candle into this important zone. Yeah, fair enough. We did not close at the lows yet, but there were so many sellers that we immediately pushed into the level. And always looking at candle size can also help your trading analysis and your technical analysis significantly. So you can see here the seller candles, the bearish candles completely dominate the market here. Very small bullish candles only. So that's a very, very important clue as well. So let's talk about maybe one more example, and I think then it will become clear, and I will highlight the most important points once again. So the market put in here a triple bottom, or here multiple touches at the bottom. We have here this little range market, then we break out to the upside, and many traders will get immediately scared out of their trades when they see a wick forming, because they immediately associate, oh, the wick here shows that there were not enough buyers, but just look at the candle here. Very strong candle, very strong breakout candle, and just one consolidation candle. So the first point is that you need to stop being so scared about wicks. Wicks are not as scary as many people make them to be. They're completely normal, and looking at candle size and also understanding that, okay, maybe the candle wick here in this area shows us that the market is really pushing into the direction of the trade here. And also understand that, is that a logical place where you can expect a wick, or at least a temporary pause? Yes, you can see that support, resistance, and now it's resistance again. So this is quite normal, quite a normal behavior. You can see here then on the way up, we have multiple wicks here, to the downside, to the upside, to the downside, to the upside. And another thing that you can do sometimes, if you want to get a bigger perspective, or you want to have more stress-free trading, just flip to the line graph and look at what the price action is telling you here. We can get rid or just leave the arrows here, but we can take a look at how is the market moving, higher lows, higher low, higher low, higher low. So very important that you can see the market is still pushing higher. We have higher highs, higher high, higher high. Yes, here's a little bit of a consolidation, but we also never break the lows. So you can see that the line graph can give you a lot of clarity, and can also remove a lot of the stress that you have from just looking at candles. Yeah, but you can see that wicks are not as scary as many people make them to be. They don't have to be scary here as well. This one probably would have scared out most traders here. Huge wick, and then maybe traders say, oh, this is a pin bar, let's go short, and if I'm long, I need to exit my long trade, and then you miss all of that. It becomes very, very frustrating. And again, a pin bar or just one wick alone is not reason enough to abandon a trade or to make a trading decision. And also, maybe the wick shows you that there are a lot of buyers in the market. They're just not ready yet, and it just takes maybe one or two more candles. And yeah, that's a very, very different way of looking at wicks. And I really encourage you to question many things that you read on the internet or in trading books, and look at things from a different perspective. Or always ask yourself, how could I else interpret this situation? I see, or the general idea, this general statistic in trading says that 95 or 99% of all traders lose money. At the same time, all traders follow the same advice and follow the same things that they read online. So maybe it's time to think a little bit outside the box, think a little bit for yourself, approach trading from a different point of view, and see where this leads you. So that's enough. Apply this knowledge, apply this concept, and looking differently at trading charts, and I'm sure you will see an improvement as well in how you read the markets.